Today we are caught in a global economic crash and depression, a calamity affecting every nation connected to the global economy, especially poor nations lacking economic reserves. But I believe that this crisis also puts into play new possibilities for a surge of social justice movements and economic democracy. From the perspective of Economics 101, every bubble mania is basically alike. But from the beginning, this one has been harder to swallow because it started people who were just trying to buy a house of their own, who usually had no concept of predatory lending, and who had no say whatsoever in the securitization boondoggle that spliced up various components of risk in order to trade them separately. It seemed a blessing to get a low-rate mortgage. It was a mystery how the banks did it, but this was their business. You trusted they knew what they were doing. Your bank resold the mortgage to an aggregator who bunched it up with thousands of other subprime mortgages, chopped the package into pieces, and sold them as corporate bonds to parties looking for extra yield. Your mortgage payments paid for the interests on the bonds. For 20 years, securitizations and derivatives were great at concocting extra yield and allowing the banks to hide their debt. Broadly speaking, a derivative is any contract that derives its value from another underlying asset, such as buying insurance. More narrowly and pertinently, it's an instrument that allows investors to speculate on the future price of something without having to buy it. The words that are used for this business, securitization, insurance, diversifying risk, all sound assuring. But highly leveraged speculation and gambling are the very essence of this business. Credit default swaps are private contracts in a completely unregulated market that allow investors to bet on whether a borrower will default. 10 years ago, that market was $150 billion. Today, it's $62 trillion, and it's at the heart of the meltdown. Credit default sellers are not required to set aside reserves to pay off claims, and in 2000, Congress exempted them from state gaming laws. AIG's derivatives unit was a huge casino selling phantom insurance with hardly any backing that now we have to pay for. The tally for the past 6 months alone: 4 bailouts, $160 billion, some very hard-to-take bonus payments, and no bottom in sight for a sinkhole of toxic debt exceeding $1 trillion. Derivatives created dangerous incentives for false accounting and made it extremely difficult to ascertain a firm's true exposure. They generated huge amounts of leverage and were developed with virtually no consideration of their broad economic consequences. So many plugged-in players rode this financial lunacy for all it was worth, caught in the terribly real pressure of the market to produce constant short-term gains. Speculators gamed the system, and regulators looked the other way. There was so much money to be made that firms couldn't bear to leave it aside for other competitors to grab. The banks got leveraged up to 50 to 1. That's where Bear Stearns was at the end, and just kept piling on debt. The mania for extra yield fed on itself, blowing away business ethics and common sense. Today, we are staring into an economic abyss, a deflationary spiral ravaging the entire world economy. Deflation, once started, has a terrible tendency to feed on itself. Income falls in a recession, which makes debt harder to bear, which discourages investment, which depresses the economy further, which leads to more deflation. To have any chance of breaking the spiral, the Obama administration has to solve the bank problem and dispose of the toxic debt. One option is Henry Paulson's original plan, cash for trash, this time with more public accountability. Another is to ramp up the insurance approach, ring-fencing bad assets by providing federal guarantees against losses. But these are more of the same options that coddle the banks and don't solve the valuation problem. that nobody trusts anybody else's balance sheet. The banks are holding at least $2 trillion of toxic debt. For the past 6 months, the banking system has been paralyzed because the big private equity firms are refusing to pay more than 30 cents on the dollar, while the big banks can't stay in business if they book such huge losses on their holdings. In the meantime, the banks are holding out for at least 60 cents and pleading for more relief. The third option, the bad bank model, creates transitional banks to soak up the bad debt. Here, the risk of getting prices wrong is even greater, assuming that the assets are valued immediately. If the government overpays for toxic securities, taxpayers are cheated. If it doesn't overpay and the banks take mark-to-market prices, many of them are going to fail. Some advocates of the bad bank strategy say the government could stall on the price issue, waiting until values rise, but FDIC Chair Sheila Bair says, no, banking is not alchemy. Assets can't be floated into the ether. So she and Tim Geithner have settled on an aggregator bank model that blends the original Paulson plan with some elements of the bad bank, topped off with an auction scheme to provide private buyers for the toxic debt. Geithner wants the government to create a $2 trillion public-private investment fund that subsidizes up to 95% of deals partnered with hedge funds and private equity firms to buy up the bad assets of the zombie banks. Since this is apparently what we're going to do, I certainly hope it works. But this plan is by far the most cumbersome and non-transparent strategy of all. It coddles the banks. It's based on the dubious hope of finding enough private buyers for rotten goods. It assumes that the private fund managers have been wrong thus far about the real value of the mortgage bundles. It offers a taxpayer guarantee to investors they won't lose money if they get in. And it depends on convincing taxpayers to pony up another $2 trillion for that purpose. Essentially, this is a scheme to pay fantastic bribes to private investors to buy the bad assets for more than they're worth. I am for biting the bullet now. It's obscene to keep paying off the very people who created this disaster. It's better to take control of the situation now than to dither for another 9 or 10 months while we lose 600,000 jobs per month. At some point, moral fairness and accountability have to enter this picture. We should nationalize the zombie banks, transfer the bad assets to a reincarnation of the 1980s Resolution Trust Corporation, and sell off the sellable parts to new owners. Nationalization is cleaner and more transparent than the alternatives. It takes hold of the valuation problem by finding the bottom. It cuts off the gusher of taxpayer gifts to bank executives and shareholders. It offers taxpayers a way of getting some of their money back. It puts an end to mergers between zombie banks, which then create more zombie banks that are too big to fail. Most importantly to me, an aggressive nationalization strategy would put into play the possibility of something more creative and constructive: establishing publicly funded venture capital banks. If we can talk seriously about creating bad banks or aggregator banks, we ought to be able to talk about creating publicly owned good banks to do good things. Public banks could finance startups and green technology that are currently languishing and provide financing for cooperatives that traditional banks spurn. They could be financed by an economic stimulus package or by claiming the good assets of banks seized by the government, or both. Obama must be pushed for anything like that, as he is surrounded by centrist corporate establishment types eager to placate Wall Street and averse to wiping out shareholders. That's where a movement for economic democracy comes in.